In today's video, we're going to answer the question for anyone who's considering buying a home or selling a home. And the question is how is the market? And that's going to be the subject of today's video, and we're going to get started right now. Hi, my name is David Matney with Nebraska Realty. I'm a local realtor here in Omaha, Nebraska. Now let's jump into today's topic. How is the market? Now, it depends on if you're a buyer or a seller. Now, let's look at it from a buyer's point of view. A year ago, buyers were in competition and were competing with multiple offers. Sometimes buyers even paid the seller's closing costs. Buyers were letting the sellers have post-occupancy, and buyers were waiving the appraisal contingency and were bringing additional funds to closing if the home didn't appraise. Buyers were buying a home and buying it as is and then waiving the home inspection contingency. Now, homes were selling not in days, but within hours. And that is not a normal market. Now, buyers are able to get inspections and ask the seller to make repairs. Buyers are able to ask the seller to pay some of the buyer's closing costs. Homes are no longer selling within hours. Homes are selling quickly, relatively speaking. Occasionally, you may see multiple offers. Now, it is more of a normal market. Why is it a more normal market? A big reason is because of inflation. Things simply cost more. Food and energy are up 15 to 20%. Families are resetting budgets. And when things cost more, it changes purchasing preferences. Now, what does that mean for long-term purchases like autos and housing? When prices go up and people are paying more for groceries, it leaves less money available to make a home purchase. This puts a damper on demand. And then we've seen the increase in interest rates. Now, a year ago, rates were just slightly over 3%. Now, at the time of this recording of this video, we're approaching 7%. That gives a buyer less buying power. They just simply can't purchase as much home as they could a year ago. For example, that means a buyer buying a house last year at 3% at a $300,000 purchase price would have a payment, and this is principal and interest, with 20% down at $1,011.85. That same buyer buying a house at a 7% interest rate at a $300,000 purchase price with 20% down would have a monthly mortgage interest payment of $1,596.73. And that's principal and interest. That monthly mortgage payment this year is 57% higher than last year. Poof, the buyers disappear. A 3% interest rate is not normal. The rates we had immediately after the pandemic for the last 2 years has been kind of like a party. As rates increase, it means the party is over, and now we're experiencing the hangover. Why are interest rates going up? Now, when you have inflation, you have too many dollars chasing too few goods. The Federal Reserve is trying to control inflation by raising interest rates to kill off demand. Now, when the Fed raises interest rates, banks charge one another to borrow money. The Fed does not raise mortgage interest rates. Now, here's the problem. In order to tame inflation, you almost have to kill the patient to cure the disease. What the Fed is doing is they're trying to slow down economic growth, which means businesses invest less and jobs will be lost. Now, let's take and look back at a little bit of history. Back in the 1970s, we had high inflation. In 1979, a new chairman of the Federal Reserve was appointed by President Carter by the guy by the name of Paul Volcker. And what he did was, when we had that spike of inflation in the early 1980s, he increased interest rates, and not by a little, but by a lot. And guess what? He crushed inflation. But here's the result of that. In that early 1980s, we had recession. Now we're going to look at a graph. In the red, you're going to see inflation, and the blue line is the 30-year fixed rate mortgage average in the United States. Now look back right before 1980, we had a severe spike in inflation. And look at that blue line. Look at how interest rates shot right along up with it. And do you see those gray bars in this graph? those gray vertical bars are recessions. So we had a spike of inflation, they increased interest rates, and then inflation came down, but then we had a recession. And look how severe it was in the late 1970s, 1980s. Now let's look over at 2020. You can see how low those interest rates got, and we had low inflation. And then all of a sudden, inflation wasn't transitory anymore. Guess what? Inflation spiked. And then what's happening to interest rates? Well, interest rates are going up. Now, what does that mean? Now, first off, in real estate, it means fewer sales. Fewer people can afford to buy a home. Now, let's look at the data. Now, we're going to look at 2019, and they had 1,500 closed sales. And then look at 2020, 2021. We were real close to that. Now, look at 2022. We're down 12.2%. And now we're down to 1,292 closed sales. And I want to look at another graph, and this one is Douglas and Sarpy County quarterly sales from 2019 to 2022, and this is courtesy of Mitchell and Associates. And you can see that in 2019, that's in red, 2020 is in yellow, 2021 is in blue, and 2022 is in green. Look at how the sales in the first quarter, second quarter are pretty comparable. But then look at quarter number 3. Look at how in green we are significantly lower than the previous year. Well, that's the impact of decrease in sales. What about home prices? Now, a recession doesn't necessarily mean that the market crashes. Now, what will happen? Let's look at the past and see what has happened to home prices during recessions in the past few decades. Now, this is the median sales price of homes sold in the United States starting way back in 1963. And then if you look, those vertical bars, those gray bars are recessions. Okay, and you can see that in 1980, the median sold price was $63,700. And then what did? They really increased interest rates to tamp down inflation, caused a recession. But look, in 1983, at the fourth quarter of 1982, prices were still up $71,600. Okay, now let's look at the recession of 2008. Went into that recession and prices went down from $233,900 to 2014 in the third quarter of 2009. And then since then, we have been on a tear going upwards. Now you can see right during the pandemic, we had a little recession. And then what happened after that? Prices just took off. And that's because they artificially stimulated the economy too much by having too low of interest rates. Now I want to look at the current inventory year over year. In 2021, we had 1,218 homes on the market. Now, if you look, 853 were existing and 365 were new construction. Well, now you look at today's inventory for 2022, we have 1,565 homes on the market. We actually went down in existing homes. There's only 799 existing homes for sale, but look at new construction. There's 766 new construction homes on the market. Now, here's the thing. That's a little misleading because a lot of those new construction, they're just lots. They're not constructed yet, or they're just holes in the ground. Okay. And then last year, because of how frenzied the market was, you had builders that weren't putting their homes on the MLS. So our inventory looks a little bit artificially high because of that. And now we're going to look at the month's supply of homes. Look at the 100,000, 100 to 200, and look at below 300,000. Look at how low of inventory of supply that we have. But then look at as we go above 300, you see that months of supply of homes increase. And that's because of affordability. As people go up in price, that 7% interest rate is a lot tougher for people buying a $500,000 home than someone buying a $200,000 home. but you can see that existing homes that are below 300 are still moving relatively quickly. That's still a good market. Now, here's something about real estate. Now, whenever somebody gets married, has a baby, gets divorced, or passes away, it creates a real estate need. There's always going to be a real estate market. Now, if you're a seller in today's market, you want to make sure you price your home correctly. You want to stage it. You want to make repairs, and you have to bring your patience. And pricing your home correctly, you should price your home to where the market is going and not where it's at or where the market has been. This is a life event market, meaning if you're a seller, sellers are only selling because they have to sell. And here's another thing that you have to consider if you're a seller. In tougher economic times, there's always a flight to quality. If you're going to hire an agent, you want an agent with experience and knowledge. And remember, agents sell real estate, not companies. If you're a buyer in today's market, you want to make sure you have your ducks lined up in a row. If you can't afford it, then don't buy it. Should you wait till prices come down? Who's to say the prices will come down? They could remain flat. If you're an investor, I think it pays to be conservative. What happens if, like Warren Buffett has said, be fearful when other people are greedy and greedy when other people are fearful? And here's another thing to remember, and that is people make money in a downturn. Look at the people that bought a home 2 years ago, right in the middle of the pandemic or right when the pandemic started, and they only had a 2.5% interest rate. There was a lot of uncertainty, but they took that risk, and that risk paid off because their home appreciated significantly since then. And what about if you're a real estate agent? I know there's some real estate agents that watch my channel. With decreasing sales, that means the pie is going to get smaller, and this is going to be a sphere of influence market. You want to hone your skills and you want to save some money. You want to live within your means because agents have to pivot and adapt. And, unfortunately, if they don't, then many agents will be leaving the business. And if you want to learn more about the home buying process, hey, be sure to check out this next video and you make it a great day.